subscribe now and press the bell icon. Never miss an update.
So we'll start with this chapter is all about dividends. So income from securities. Securities would mean shares and stocks and anything which is related to the stocks of a company or some kind of financial instrument where people can put in the money. Usually securities are considered to be same as stocks, and now the entire chapter is going to be focused on dividends. So in US there is a concept called qualified dividend. So what does that mean? The dividends can be of two types: ordinary dividends and qualified dividends. Qualified dividends are the ones which get taxed at a lower rate, at a better rate. So we should try to have as high qualified dividends as possible. And the condition is very simple for it to be considered as qualified. So first of all, their dividend from domestic corporations. Yeah, obviously the foreign corporations are not covered here unless they're qualified foreign corporation. I mean, there are certain conditions for that, but generally foreign corporations' dividend would not be considered as qualified. And they're taxed at 0, 15, 20% depending upon the tax slab and filing status and all. And the dividends must be held for more than 60 days or 90 days for preferred stock. So that's very, very simple condition. Pretty much a lot of it would be considered as qualified only, because it's not like they have to, they have to hold it for more than 1, 2, 3 years, and all that is considered to be a long time. It's only 60 days. Okay, so, and then you will usually, can anyone tell me, Sakshi, maybe what kind of form does one receive, which tells that the taxpayer may have dividend income?
1099 div.
Very nice. 1099 div. Yeah, we call it 1099 div. So the moment you see a 1099 div, either in the last year filing or current year filing, anytime, then we should definitely assume that this dividends is going to be dividends will be taxable income for current year as well. Very unlikely that the taxpayer has liquidated all his securities and there'll be zero dividend. No, we should definitely go ahead and ask if the amount is significantly low or even high. High is not a problem because we are putting more for taxation. So we are good, we are covered from IRS risk point of view. But when it goes down, we should definitely ask the taxpayer what happened. Did you sell off the stock? Why dividends are not as high as they were last year? Or is the company not paying dividend? Yeah, all those questions, and we should try to understand why there is a dip. And this is nothing new for dividends. For every item of income, we should follow the same process. Okay, and we should not just blindly go away with the forms that are given and just take those 5-10 forms and start putting them in without realizing what's been done last year. It always has to be consistent. It should make sense from one year to the other year. It should make sense when we talk to the client. We try to understand, what has happened with their financial assets in last 1 year, and that story should tie with increase or decrease in the taxable income for that particular year. Okay, so a dividend for purpose of taxable income is generally any distribution of money or even property made by a corporation to its shareholders. So not necessarily it has to be a cash dividend. It can be given in any other form as well. It can be given in by way of distributing some property, or by even way of giving more stocks to the shareholders. The company may not have cash to give, so they'll say, we can issue more stocks and we'll give you that, and the fair market value of those stocks is so and so. So we can always understand what is the value of the dividends that the shareholder has received. Any distribution in excess of earning and profit, if there are no earnings and profits, or if there are no retained earnings, and everything has been distributed, then on top of that, again, if company is distributing something, then that's not dividend, that's return of capital. right? There's no dividend is meant to be distributed only when there are profits or retained earnings and all. When it's all being already distributed, we cannot dig into it further. Then and again, but the company does want to distribute something, we should take that as return of capital and see if capital gain is applicable to that. But it won't be considered as dividend income. I mean, that's again a very simple and basic concept. Nothing new there, nothing new when it comes to US or India or any other country's taxation. It's done. That's what dividend means, something which gets distributed out of profit. So once basis is reduced to zero, okay. Um, so if basis is reduced, what does basis mean? We'll see this word quite often, like basis. Every time we read about this, what is the basis for this asset, basis for that asset? That just means cost basis. What is the original investment amount that has been put in? Okay, and if you have put in say $100,000, you already got full $100,000 back, and if you're getting $20,000 more on top of it, then obviously that 20,000 becomes gains. It's not going to be regular income because this is coming out of the investment, so it's going to be some kind of gain only. Okay, dividends paid or credited by a credit union or saving and loan are not qualified dividend. That's fine. If there is a credit union and all, like those are giving dividends, they are not considered to be qualified. We don't see what is qualified, what is not. I mean, we don't see where it is coming from. Usually we'll get a 1099, and based on that, we'll do the filings. But if we are working for a company which has issued dividends, then we have to prepare proper 1099 divs, and those need to be distributed amongst all the shareholders. So with that time, we need to be very sure, do we need to mark all of them as ordinary dividend, or part of those dividends are considered to be qualified dividend? So there's more responsibility on the company's end. If they issue something, I mean, taxpayer just has to take that 1099 and punch that in the tax return, and then put it at 1040. Mutual funds, domestic. We're talking about mutual funds, domestic only. Do not get it confused by foreign mutual funds. Foreign mutual funds are completely different. Now, obviously, when we're talking about foreign mutual funds, we need to understand what is foreign from US perspective, not from India or some other country perspective. Right? So any mutual fund, if the taxpayer has invested money in US mutual funds, okay. So yeah, there could be dividend, from a fund investing in tax exempt securities and all, and there'll be like a tax exempt interest, and also we have to see what is the character of the income source. So there could be exempt dividends. There's a lot of time on 1099 divs, there is a box which is called capital gain distribution, and sometimes we see the money is put up there. That usually comes when the taxpayer has put money into mutual funds, like if they are moving from one fund to the other fund, or their financial advisor must be doing it on their behalf. So there's something which could get captured as capital gain distributions, and they're usually long term only. Anytime you see any amount, it will go like as reported as capital gain distribution on 1099 tab, it will be considered as long term only. If the capital gain remains undistributed, the taxpayer still report. Yeah, it doesn't matter as long as the income is earned. Right? It doesn't matter whether you have actually received it or not, if it's as long as it is earned, because not necessarily the people will take out their money, right? They will just leave it in the brokerage account, or they would just reinvest it and all. So, or it would just sit over there undistributed, but the statement would show that this is what you have earned. The taxes can be anything, 0 to even there could be a situation when you're actually not paying anything, when the income is very, very low. It can go as high up to 28%. Mutual funds and REITs. REITs are some special real estate trusts and all, and they may retain their long-term capital gain and pay tax of them instead of distributing them. And usually those REITs will issue K1s. And on K1s, we will see those amounts. You may not get 1099s because they, they are like more like a investment company where people can put in the money and they become one of the partners and all. And usually they're given K1s. So, anyways, we already saw that it, as long as it is earned, it needs to be reported. Now, there's something called dividend reinvestment plan. So, the dividend could, instead of taking the cash out, it could again be reinvested. So, does that change? Does that change the basic idea of taxing dividends? Anyone?
It will matter, no? Because usually the holding period is 60 days versus 90 days, and every time, usually in mutual funds, if you remove and put in, there is a withdrawal fee and investment, this, right?
No, I'm not asking that whole thing. I'm just asking, it doesn't matter. Actually, the answer is doesn't matter because how does it matter? Like if you're earning interest on a FD in the bank, you take that out and put it in your savings, or you just say, you tell to bank again that, okay, again, add it to my FD again and then renew it. Does it matter? Like, I mean, that the interest that you have earned on FD will still be considered as taxable, whether you are taking it out or not. So my question was that whether you take it out or not, how does that matter? It's the income which is being earned by a taxpayer. We are not doing cash basis here, right? That if you don't get it, you don't, like, I mean, it's just like something that you have earned. You have a right to take it out. But if you say that, oh, I don't want to take it out, I just want you to, take my money again and reinvest in the company, then it's fine. That's like, it's again, you're just growing your own investment. So first it should come up for taxability. Okay, so a dividend reinvestment plan allows a taxpayer to use his or her dividends to buy more shares of stock instead of receiving the dividends in cash. Otherwise, you do it in a long way. You tell company that give me my dividends in cash. Let's say they give you $10,000 of dividends income. Again, you give that money back to the company saying that, okay, you take it back and I want to purchase more stocks with that $10,000. Instead of doing that, the entire process, what we are telling is, okay, fine, I've earned $10,000, but I just want to buy more stocks. I'm reinvesting. So the basis of stock, wait a minute, the basis of stock received as a result of dividend reinvestment is fair market value, even if purchased at a discounted price. Fine. So you receive $10,000. We are saying that, okay, I want to buy it again. We'll have to buy the stocks at fair market value, usually. Otherwise, if it's a private company, it's giving the stock at a value which is lower or higher than fair market value, then your basis has to be adjusted accordingly. Because why basis adjustment is very important. Maybe not today. It doesn't matter whether you add that $10,000 back to your basis or not. But later, when you're selling the entire stock, if you don't have the right basis, you'll end up paying more in capital gains, or we'll end up paying less, which will again put us into a problem. The basis of stock received as a result of dividend reinvestment plan is fair market value. We have to always see what is fair market value. So let's say you're giving $10,000 back to the company. The company is giving you stocks which are worth $12,000. Then what happens to the 2,000 extra? It should be considered as taxable. And when it is coming up as taxable, that means you're taking that as an income, you're paying taxes on it. So it gets added to your investment cost. Earlier, maybe you had put in $100,000 in your total investment in that company. Now the company is giving you worth something $12,000. So now your total investment in the company will become $112,000. Even though the dividend reinvested is only 10,000. So what will happen is the difference between fair market value and what you're investing is considered to be a benefit given to the taxpayer, and that has to be considered as taxable. then if they have given stock at a price equal to fair market value, fine. I mean, you must still report the dividends as income and all. These are all the different points that they're giving here. A member of dividend reinvestment plan, okay, if you're buying the stock at less than fair market value, we must report as income the fair market value of the additional stock on the dividend payment date. We have to report, we have to always see what is the benefit that one is getting and report that also as income. If the dividend reinvestment plan allows member to invest more cash to buy shares of stock at a price less than fair market value, yeah, okay. So here the dividend is getting invested. What is the difference between point C and point D? Point C is like you're getting stocks of less than, like, okay, let the member buy more stock at a price of less than fair market value. So basically, my example that, okay, you're paying actually 10,000, but you're getting something for 12,000. So the price that you are paying is less than fair market value. Now here, what is happening is they're also paying cash along with the dividend reinvestment. So basically, like the dividend is say only $10,000, and the stocks that you want to buy are for $15,000. So you'll put an extra $5,000 cash. Say that, okay, use my dividends for 10,000, and plus I'll put in an extra another $5,000. Use that as a cash and buy more stocks. But again, if you're getting the stocks at a lesser than fair market value, we have to see what is the difference between what the member has invested and the fair market value. And fair market value of the stock is determined on the dividend payment date, because this is dividend reinvestment. So the moment the dividend is declared, you have already instructed the company that I want to reinvest it again. So whatever will be the value of the stock on the dividend payment date, that we need to consider and see. I mean, we need to compare it and see, is that all happening at fair market value? Fine, no problem. Is there something which is happening? You're getting a special treatment. I mean, like the outsiders are buying at $15,000, but you being an existing shareholder, you're getting it $12,000. So obviously there is an income element there for the shareholder. So that has to be reported as taxable. We'll just go over one of the example, then it will make it clear. Reinvested dividends are taxable in the year paid. Fine, we know that they're all taxable. It's not like if we are reinvesting it, we're not taking it actually in our hands, doesn't mean that we have not earned the income. We have earned the income already. Whatever now we do with that income, we invest it again, we take it out, we give it to somebody else, we put it in another stock, whatever it is, whatever you want to do, or we give it as a gift. That's a second level to it. The first and the base level is that you have received the income. So the moment the income is received, tax will come into the picture. Obviously, reinvested dividends are added to the basis of the stock. Why this has to be added to the basis of the stock? Shweta, can you explain why this has to be added to the basis of the stock? Are you there?
Yeah, I'm there, but I'm...
Okay, think about it. I don't know why we are confused about this. This is a simple concept. Anyone else wants to answer?
Can I answer?
Yes, please go ahead.
To calculate number of stock, number of stock, number of share.
Number of shares or the value of the shares? How does it matter whether I have 1 share or 10 share or 100 shares?
Then closing NAV.
Yeah, closing NAV, maybe that makes more sense. Okay, think about it this way, Shweta, let's pay attention again, and everybody else who has not understood it. If you are given $10,000 as dividend, okay, you're already holding an asset of $100,000. That's why you're given 10% as dividend, okay? Is that thing is clear? You have a stock investment of $100,000. Company has declared a dividend of $10,000. You'll take it, you'll put it as your income. Now you're telling the company that take this $10,000 back. I really like your company, I really like your stocks. I want to buy more of them. Whatever that $10,000 will bring it. Okay, so you are reinvesting in stocks. You're telling the company that take this money back. So now what is your basis in that investment now? Has it not grown?
Yes, it is.
From 100,000, did it not become 112,000? Like, or think about it, like you don't even get dividends. You just like the stock. You get your some income from some other place, and you tell the company that, okay, I want to buy your more stock. First, you have a stock of $100,000. You put in another 10,000, 20,000, and you're saying, okay, I want to buy more. Then next year you say, okay, I'll put another 10,000. I want to buy more. So every time you're buying, you're increasing the cost basis, na? The same thing. Otherwise, if you don't increase the cost basis, like tomorrow when you're selling off everything at $200,000, your gains are going to be 100,000. Actually, when if you have invested again 20,000, actually your gain should be 80 only. 200,000 less 120, not 100. Are we clear now?
Yes, ma'am.
Honey, are you clear? Tanya, Siddhavi? So you're clear, right? I mean, you understood, Raksha. Anything that you want to add here?
No, it's like in simple words, we can assume that we have taken dividend, that is cash with us, and then we have invested again. So since
Yeah,
we
yeah.
purchased more stock, so its cost should increase then.
Sai and Hemant, you there?
Yes, ma'am.
Okay, Hemant, why don't you read this thing? Example. And you
A
also need to
taxpayer.
explain it, huh?
Okay. A taxpayer at the company with a dividend reinvestment plan has 100 shares of the stock and opts and use the cash and dividend purchase 10 more shares. The total price of $1 when the total MFU of 10 shares is $20. The transaction cost is 0.50 cents, which is deducted from the cash dividend prior to purchase of the stock. The taxpayer dividend income is $20.50. Is 10 shares into 2 shares and plus 0.50 as charge. So it's coming.
Don't worry about this thing. Don't worry about this thing. This is probably I must have put in last time. So now try to explain what is happening here.
Taxpayer who reinvested 100 shares of stocks and he has opted as a cash, but he purchased 10 more shares for the total price of $1.
Correct. So he gave only $1 to company and he got 10 more shares,
Yes, ma'am.
right?
Yes.
And what is the total FMV of those 10 shares?
Total FMB of 10 shares is $20.
Why? Because every share is like $2 each. But because maybe this person is already being a shareholder and all, and they get some very special discounted price, whatever, from the company. But actually, the fair market, if any other third person, totally unrelated, wants to go and buy the stock, they would have paid $20 for 10
Yes.
shares. So there is a transaction cost also for 50 cents, which is okay. Now, how do you know what is the income here? What is the taxpayer's dividend income? Heman?
Yes, ma'am. Ma'am, for each share it's costing 0.50 or for 20 shares it's costing 0.50.
No, for 20 shares it's costing 0.50.
Okay.
Yeah, you don't have to do 0.5 times 20 and all. For the total transaction cost is 50 cents.
Okay. So 10 shares is equals to 2 shares. So it's coming 20.50. But
Right. So it's coming 20.50 because that 50 cents is something that they are paying it. So here, if you see it,
That's the transaction cost.
so he's paying a total price of $1. and the total FMV of shares is $20. Maybe either you do it this way or this way. I mean, it's going to come to the same thing. So either we just go it and take like, okay, 10 shares plus times 2 will come to $20, plus 50 cents is something that company itself has paid as transaction charge on behalf of the taxpayer. The taxpayer didn't have to pay anything. I don't think this is right. I don't think we should do it this way. This is what we need to do. So we always saw that the fair market value has to be reported as the income. So what is the fair market value?
Fair market value for 10 shares is $20.
Yes. And the company is also, the transaction cost is 50 cents also, which is deducted from the cash dividend. And also that this person is not paying anything there. So the total benefit that the person is getting is 50 cents. $20.50.
Yes, ma'am.
Okay.
Yeah, ma'am.
So any questions here? Are we clear? We have to go with the fair market value. What is the total fair market value? Okay, we'll go to the next one now. What time is it? Okay. Stock dividend. Now, there's something called stock dividends. Basically, it's the rights given to acquire more stock and all. Again, those, instead of giving cash dividend, the company is giving a right to acquire more stock. So again, if that right is given, is like, the rights issue and all, I think we call it in India. So there has to be some value to it. Okay, so let's go over that. Generally, a shareholder does not include in gross income the value of a stock dividend or right to acquire stock declared on its own shares, unless one of the 5 exception applies. If you're just given a right to acquire stock, generally they will not do it unless there are other exceptions, which is like if the shareholder can elect to receive cash or other property. If the company is telling that, okay, you'll receive stock dividend, plus you can also receive cash, or if you don't want cash or stock dividend, we can just compensate you in some other way. If they're giving all these things, that means there's some real income element there, and that has to be reported. So those are the exceptions. That means the income needs to be reported. Shareholder receive cash or other property and other, okay, so there's some disproportionate things. Some shareholders are receiving cash, some shareholders are receiving something else and all. So that is not allowed. It has to be common for everybody. Some common stock shareholders receive preferred and some are receiving common stock. Again, that's not allowed. The distribution is on preferred stock, but a distribution of preferred stock merely to adjust conversion ratio, stock split and all. I mean, anywhere these kind of conditions come in, then it will come up as taxable. Generally, otherwise stock dividends are not taxable. If a shareholder receives common stock and cash, so again the shareholder is receiving stock as well as cash. So if the cash element comes in there, it will all be considered as taxable. If it's a very, very simple and straightforward thing that all the shareholders of the company, get stock dividends in the same proportion. So if you're holding 10,000 share, you will get 1. If you're holding 100,000 share, you will get 10. So basically you're getting like whatever, 1% or 10%. Okay, so if you're following the same proportion for everybody, and there is no other choice given, or there is no mix of different stock, that on common stock you're giving a right to acquire preferred stock, none of that is happening, then that means the stock dividend is not taxable. If any of those conditions happen, then we have to see what is the total fair market value of the stocks given and how to calculate the taxable portion of that stock dividend. And maybe the fair market value is high or low, and all those things will come to the picture. Or if there are different kind of stocks, what is the value of preferred stock versus common stock? Or how much is the cash given, because cash is cash. Cash doesn't have to have a fair market value, right? So we can exclude that part and then put FMV thing on the other properties or any other stocks given. Okay, these are all different kind of stocks. Constructive dividends, anyways, like payment of personal expenses by corporation. Corporation says to the major shareholder or very important shareholder, hey, you don't have to pay your car's EMI. Okay, we'll take care of it. Don't worry. You've been one of the best investors in the company, whatever, and all. You put in so much, we'll do that much for you. So if that person doesn't have benefit that a person is getting, so it can be considered as a constructive dividend. Actually, the dividends are not released, it's not like declared and all, but still under constructive dividend, it can come up as a taxable income. Okay, now this is very important. Non-statutory stock options. Sorry, I have NQSOs, ISOs. ISOs are incentive stock options, and ESPP, employee stock purchase plan. This is something we very commonly will see these things. So now this portion of the of this unit is more important than anything else, because we definitely need to understand. And if you're not able to understand, please make your notes. If you write it down, probably otherwise it will be very confusing. If I say NQSOs or qualified stock options are this and that, and suddenly I'll say ISOs are this. If it's not clear in your mind, you will keep confusing what are ISOs, what are NSOs. Maybe this is the tax treatment for NSOs or NQSOs. You can also call them NSOs. Instead of calling NQSOs, I can always call them non-statutory stock options or non-qualified stock options. That's what Q is for. So we need to understand it properly, because the tax treatment is completely different for all those three different kind of stocks given, and majority of our clients will have this thing in their tax returns that we are computing. Majority are going to have some of the other kind of stock income, because they're all working for tech companies. They're all like given stock options or any, like it's very common for a person to receive stock options. So if the person is not in tech industry, one can understand, but our clients are coming from there, we all will have this kind of complexity. The point is that here at least you should be able to distinguish what is NQSOs, what is ISO, what is ESPP, and maybe a broader level of have some tax idea. I don't even expect you to remember all those rules, but something should be clear. At least don't mix up all those things. At least when you're working on the tax return, you need to know, oh, okay, if the client tells you I have some stock options, we should be able to ask that question, what kind of stock options? Then the client says, well, I don't know, the stock options are only stock options. I don't know what you're asking. Don't get confused, or like don't lose your confidence on that. You have to still ask. Okay, you need to tell them that, see, stock options are of two types. If you're talking about the options, they're of two types. If you're talking about just stocks being given to you as part of compensation, it could be ESPP, which is employee stock purchase plan. Those are not options, those are direct stocks. Or there could be RSUs, restricted stock units. Again, those are direct stocks. Those are not options. We need to understand what is the difference between options and stocks. The name itself says that. The name itself says stock option, meaning you have an option to receive that stock. You have a choice. You want it, you don't want it, make a choice. When you're giving RSUs, you don't have a choice. You just see it sitting on your W2 or your Form 16. Well, the company has given stock. They're not asking you whether you want it or not. It just comes up as a taxable thing on your W2. Okay, so wherever there are stock options, that means you are given a choice. The taxpayer is given a choice. So only when you go ahead and tell the company that, okay, I want to get those stocks, then only all the taxability will come into the picture. If you tell the company, well, I really don't care about your stocks and all. Anyways, the company is doing bad. I don't want any of your stocks and all those things. Then fine. Then the stock options doesn't even matter. The company will give it to you. After 4 or 5 years, they will expire. You don't do anything. It's then you just lose the right to buy them. That's it. You are losing the right to buy them. You're not losing the stocks themselves. Is it clear, Divyansh and Ayush, Aman, and like Rohit? I really want you guys to even speak up and tell whether you're able to understand it or not.
Yes, ma'am.
Divyansh, is it clear to you? What is the difference between stock options and stocks? Is it there?
Hello, ma'am.
Yes, go ahead.
Ma'am, stock options are the plan, ma'am, where the non-restricted stocks options and ma'am, which are there? The options can be sold and ma'am, they are granted.
Correct. Correct. Yeah,
And
you're right. Go ahead. Go ahead. You're saying it right.
and ma'am,
Initially,
yes, ma'am.
as the name says, it's an option given to you.
Yeah, ma'am.
If there is an option given to you, you want to have tea or coffee, and if you say coffee, then only you basically you get the coffee,
Yeah.
right? It's an option given to you. No one is forcing you to have it. If you say I don't want any tea or coffee, nothing, and fine, you don't you don't get anything, and nothing is taxable to you.
Yes, ma'am.
Understood?
Yes, ma'am.
Okay, so let's go over that. I hope it's clear. If not, you guys need to go over it and then understand it. And I don't even expect you to get it all in one way, one like class, but then pay attention at least. Let's try to see what best we can get out of it. Non-statutory stock option, NQSOs, they call it, non-qualified or whatever. So there's something, the simple meaning, simple words, it means these are the stock options which do not get favorable tax treatment. They do not qualify for favorable tax treatment. That means the tax you are paying on these kind of options is always high versus the tax that you're paying on incentive stock option or qualified stock option, that it says that you're qualified for the favorable or better tax treatment. So always ISOs will give some kind of taxable benefit to the employee. There are a lot of conditions around it. Who can be issued ISOs, who can be issued NQSOs and all. Let's not get into that right now because I don't want to confuse more. But what we need to understand is which one will have better tax treatment? Ayush, which one will have better tax treatment? Between this and this. Is it there, honey?
Yes, ma'am.
Yes, tell me. Anyone else? Anurag?
I also have better tax treatment.
Exactly. You need to pay attention. Okay, I'm just asking the question on the very much sentence which I just repeated like 5 seconds back.
Yes, ma'am.
So don't get confused. There's nothing new that I'm asking. I'm just repeating the same thing and asking it. It's nothing like out of the blue. Okay, so let's go over that. NQSOs, they say that they do not qualify for favorable tax treatment. They're usually taxed at ordinary income rate when they're granted, or actually when they are vested and all, or when they're exercised. Exercise is much more important than granted, but then we will see the grant date also plays an important role. When is that given to you? Maybe it was given in year 2020, okay, and you are exercising that in year 2023. We have to see what is the grant date, what was the market value on grant date, at what price was it granted to the employee, what happened in 3 years, has it gone, the fair market value has gone high or it has gone low, what actually is happening. Depending upon all of that, we have to calculate what is going to be the taxable portion and at what rate it will be taxed. Generally, it will come up at ordinary income tax rate. That's why we call it that they do not qualify for favorable tax treatment because they're coming up at ordinary income rate. The other one, ISO, will come up at capital gain rate. Mostly they'll be long-term capital gain rate if certain conditions are fulfilled. Obviously, everything, the conditions have to be fulfilled, right? So that should go without saying. There's no such rule that, okay, whatever happens, you will get it at long-term capital gains. No, there have to be always some conditions and all. Okay, so we have to ascertain what is the fair market value. Sometimes private companies do not have a fair market value, or it's not easy for us to find it. So that's why we get that 409 evaluation done. Based on that, we'll see what is the value of the stock. Okay, but public companies is very easy to know what price is it being listed on stock market or what price it is being traded on stock market. That is fair market value. So we can understand what is the fair market value. So we'll go over this example that will make it clear. So, but then we have to ascertain the fair market value at the time it is granted in connection with the performance of services. Because the stock options are given only if you're performing the services, right? Without performing services, you cannot come and the outsider cannot come and say, hey, give me some stock options, I'm ready to pay you money. It's meant only for employees or for vendors or for advisors or for people, those who are giving some kind of service to the company. So there has to be a performance of some service. And the performance of service realizes compensation when the rights of the options become transferable. When you actually exercise the option, you have a control on them, you can buy them and you say, then you are free, then you become the owner. You can give it to anybody you want to, you can do whatever. That's when we have to see what is the taxable income, because now you have become the owner. When it was granted, you were not the owner. The company just told you, well, you know what, we are giving you 10,000 stock options. If you want, you buy them at very low price, because if outsider people are buying at $100, maybe you can buy it at $20 because you're an employee. Right? So we always have to see what is the difference at what a third party would be buying at $100. An employee is getting it 20. What is the difference? $80. So that $80 becomes a compensation because it is directly related to performance of service. Because you're an employee, giving you discount. So it's kind of a compensation income. Compensation income, salary income will get taxed at very, very high rate, maybe the highest rate, ordinary income tax rate. Okay, let's go over this thing. Sakshi, you want to read this?
Yes, ma'am.
Example on non-statutory stock option, non-statutory, non-qualified, not qualified for favorable tax treatment. Go ahead.
Yes, okay, ma'am. Mary Martin is granted a non-statutory option to buy 5,000 shares of her employer's stock at $50 per share for 5 years. At the time, the stock is selling for $45 per share. 3 years later, Mary exercises the option when the stock is selling for $55 per share. Mary has no income and her employer receives no deduction at the time the option is granted.
Right, so this is important. When the option is granted, she's just given a choice. You want it, you don't want it. If she says, I want to take more time to decide, fine. Like, no income to you, no deduction also for employer. But upon exercise is the time Mary has decided that, okay, I want these stocks. The moment she says, I want these stocks, that is called the exercise of the option. Go ahead, Sakshi, read it from here. Upon exercise of option.
Upon exercise of the option, Mary has ordinary compensation of $25,000. The bargain element, and her employer receives a corresponding deduction. Mary's basis in the stock is $275,000. Upon a later sale, Mary generates a short or long-term capital gain or loss with a holding period starting at the time the option is exercised.
Okay. So yeah, let's just stop here. No need to read this thing. These are all our. Let's just stop here. Let's just write down these things. Can anyone write down, or maybe all of you? How many stocks has she got as options? 5,000. Please write them down. At the time of grant, no, sorry, the option to buy at $50 per share. So what is her, if she is going to buy it, she's going to buy it at $50 per share. So please write down the cost or the buying price for Mary is $50. Okay. And that time when, 1 minute, to option 5, buy 5,000 share of employer stock at 50 per share for 5 years. At the time the stock, yeah, for next 5 years she is giving this option. Okay, the company is saying the next 5 years you can buy a stock at 50 per share. But when it was given to her at the time of grant, the stock was at only 45 per share. So obviously, why will she go for employer price? Employer is saying you can take it at $50. Market, the stock exchange is saying we are selling it for $45. Right? This is at the time of granting. So don't worry about it. Mary is saying, fine, I have 5 years to decide. Let me see, if $50 makes sense or not. Maybe after 5 years, if the stock shoots up to $200, I'll make a lot of money. Why? Because I will still get it at $50 per share, but now the value is 200. So Mary is thinking that, okay, I'll decide on that. She's not making any decision at the time of grant. She's just sitting on it. So if she's just sitting on it, there is no income to her. Now, after 3 years, Mary exercised the option. After 3 years, Mary has done her research and analysis and all, and Mary came to the conclusion that, okay, this company is doing good. Maybe I should invest in that stock. Okay, but because the stock went up to 55 per share, from 45, the stock went up to 55. She has the right to buy it at 50 per share. Write this down. At the time of exercise the option, the fair market value of the stock is 55 per share. So upon exercise of the option, Mary has ordinary compensation of $25,000. How much is Mary paying for exercise of the option? Muskan, are you there?
Yes, ma'am. Yes, ma'am.
How much is he paying? How much she is paying to exercise the stocks?
Ma'am, ordinary compensation, she's paying $25,000.
I'm not asking you that. Please don't repeat what is said here, what is written here. What I'm asking is, how much is she paying for exercising these stocks? Do not repeat what is given here. You just use your own calculations and use your own learning to come up with the answer. Anyone else who can give the answer? Hemant, you need to tell how much is she paying? Hemant, are you there? Okay, is he not there?
Ma'am, 250,000.
And is that you, Sakshi?
Yes, ma'am.
Yeah. Can you explain how this is coming?
5,000 shares into $50. $50 is the exercise price.
Correct. Do you get it now? All others who are not able to answer? Everything is over here. The purchase cost is written here. It's already but I don't want you to go through that. I mean, you'll be confusing. Just understand what is given here. How much is she buying for? How much is she buying for? 5,000 times 50. Okay, so that becomes 250,000. Now, what is the value that she is getting? What is the value that she's getting today? Shweta?
$275,000.
How did you derive that?
That is $5,000. 5,000 shares multiplied by 55 per share.
Correct. So, but then she's paying 250,000 and she's getting, sorry, yeah, she's paying $250,000. She's getting something which is worth $275,000. What is the difference between these two?
25,000.
25,000. Will IRS tell you, okay, you keep this free money for $25,000? Will IRS do that? Why? They are not doing any charity there. No? Why would they do that? They'll say, well, you have earned this income. You got a benefit of $25,000. So you please pay that as taxes. I mean, pay taxes on that. Are you able to understand? Divyansh, Anurag, Rohit there, and Jen?
Yes, ma'am.
Yes, ma'am.
And what about now Muskan and Ayush and all?
Yes, ma'am.
Yes, ma'am.
He's getting a benefit, right, of $25,000. I hope you are all like, this is very simple concept. You need to understand this thing. It's very simple thing. Like, put it in your day-to-day life and see. If somebody is telling you, well, today the gold price is whatever, say 50,000 rupees. You just, you don't have to pay me anything. Just pay me like 20% of that. And after 3 years also, I will give you the gold at 50,000 rupees only. So that means after 3 years, maybe the gold become like 75,000. You are still getting it 50,000. Are you not making money there? You're making money, right? This is what happens when you do this futures, options, and all or call put. You're freezing your price, saying that okay, I am taking the option to buy it or to sell it at so and so. Now, if the market goes high and low, either you'll make profits or you'll make losses. Here, she's making profit. She's getting something which is worth 275, but from her pocket, she's paying only $250,000. So that extra $25,000, how will it get taxed to her? It's an ordinary compensation. She is an employee of the company. She is getting this beneficial price because she's an employee. It has to come up as ordinary compensation. If she were just doing the trading on stock market, buying, selling, whatever, then she would have taken that as capital gains, if provided she fulfill certain condition or trading income or whatever. She's an employee. She will get ordinary compensation of this much. Now, Tanya, what will be her cost basis?
275,000.
Exactly. This is going to be 275,000. Her basis is because she's paying this much from her pocket. This much is what she has earned. She has paid taxes on it. So she has put in a total cost of 275,000. Tomorrow, if she's selling it at whatever, I don't know what we took here. If she's in year 8, if she's selling it at $100 price per stock, she's selling entire stock at $500,000. And her cost is still 275. That's the capital gain. So 500,000 minus 275, so $225,000 is her capital gain, long-term capital gain, on which she's paying 0.20 or 20%. So she'll be paying $45,000 in taxes. Versus if the stock price goes to $40 in year 8, from 100, let's say that the whole stock market has gone down and all these scams have happened, whatever, now suddenly the stock, she bought it at $50. She took that extra $25,000, the compensation. She paid taxes on it. Suddenly the situation changed. Now that $50 stock or $55 per share became $40. So she wants to sell all that in year 8 because she's thinking, oh, maybe from 40 it will go to 30 or 25. Let me just sell whatever I have. At least my losses will be less. So she's selling everything at $200,000. But what is her cost basis? Muskan, what is her cost basis?
$275,000.
Exactly, 275. So she's making a loss here. She's getting 200,000. She's her cost basis is 275. There's a $75,000 loss. This will come up as capital loss. This will come up as capital gain. Okay, these are all capital loss and capital gains. It has nothing to do with compensation income. Only this, the difference between the fair market value and what she is paying will come up as ordinary compensation. The capital gain comes into the picture. Another thumb rule, if you're getting too confused, instead of mugging it up, put the logic. The capital gain comes into the picture only when there is a sale, or capital loss or capital gain, whatever. That will come into the picture only when there is a sale. If she just bought something for $50, she doesn't want to sell it for next 10, 15, 20 years. She's like, it's just sitting with her. No capital gain will come up. Okay. So I think this is a lot for us for one class. We'll just continue it later.